Welcome back to Focus Fridays, this series where we open up the playbook on real estate investing from foundational concepts to the sophisticated strategies that help investors grow wealth with confidence. I'm Jared Shum, head of investor relations here at Focus Capital, and today I'm flying solo. If you've spent time reviewing private real estate offerings, you've probably seen the terms 506B and 506C buried somewhere in the fine print. And maybe you gloss right over them, but today we're not going to gloss right over them. So these two exemptions under SEC Regulation D govern how private real estate deals can be offered and marketed towards investors. They determine who can invest, how operators can communicate their deals, and what obligations both sponsors and investors carry. This matters more than most investors realize. Understanding the difference between the two isn't just regulatory trivia. It directly affects how you discover opportunities, how you qualify to participate, what protections are built into the structure, and a couple of other things that we'll talk about later in this episode. So by the end of this episode, you'll know exactly what these terms mean, why they exist, and how to think of them the next time you're reviewing an offering. So why does any of this exist? Here's some of the regulatory backdrop. Before we get into the specifics of 506B and 506C, it's helpful to understand the framework that they sit within because that context makes the rules so much easier to remember. So when a company, including a real estate sponsor such as ourselves, raises capital from investors, that activity is regulated by the SEC, or the Securities and Exchange Commission. The SEC's job is to protect investors from fraud and ensure that they have enough information to make informed decisions. That default requirement under the securities law is full registration of the offering. It's a lengthy, expensive, highly public process that makes sense for a company doing an IPO, but is completely impractical for a private real estate syndication trying to raise $5 million from a small group of accredited investors. Regulation D is a set of safe harbor exemptions that allows private companies and sponsors to raise capital without going through full SEC registration, provided that they follow specific rules around who they can accept as investors and how they communicate the deal. Think of Regulation D as a private placement framework. It's how a vast majority of private real estate deals are legally structured. And within Regulation D, there's 506B and 506C, and those are the two most commonly used exemptions. They share some same characteristics. Both allow unlimited capital raises and both require federal filing, but they differ in two critical ways: who can invest and how the offering can be marketed. So we'll start with 506B. A 506B offering is more traditionally structured, and it remains the most widely used exemption in private real estate syndications by a significant margin. Under 506B, a sponsor can raise an unlimited amount of capital from an unlimited amount of accredited investors, but the key constraint is they cannot use general solicitation or advertising to market the deal. No public posts about specific offerings, no advertising campaigns, no open webinars promoting the live deal to a broad audience, anything like that. Instead, sponsors operating under a 506B must have a pre-existing substantive relationship with investors before presenting them with the investment opportunity. The relationship doesn't need to be formal, documented in a specific way, but it needs to be real and it needs to have been developed before the deal was brought to market. So what does this look like in practice? A relationship developed through months of educational content, investor calls, newsletter subscriptions, or a genuine back and forth communication qualifies, or personal friends, network, family, etc. A cold email to someone who clicked on a LinkedIn ad yesterday doesn't count. It has to be a relationship that developed through months of correspondence. There's also an important provision within 506B that often gets overlooked. It allows up to 35 sophisticated but non-accredited investors to participate. So these are investors who don't meet the formal accredited investor definition, but who have sufficient financial knowledge and experience to evaluate an investment on their merits. So in practice, most sponsors limit the participation to accredited investors to simplify their compliance and investor relations, but that option does exist. One practical takeaway from all of this for investors: if you're being introduced to a 506B deal, it means the sponsor already has a relationship with you or believes that they do. You won't find these opportunities advertised publicly. They come through direct outreach, investor networks, or referrals, or operators you've been following and engaging with over time. This is one of the main reasons we invest so heavily in building relationships with our investor community at Focus Capital. The content we create, the conversations we have, the transparency we maintain, all of that is how those genuine relationships are built. And it's also why Focus Fridays exist. We want to be able to educate people, not just on what we invest in, but also how to evaluate operators between deals and which types of offerings they have. So we here at Focus Capital operate mostly within the 506C offering. So a 506C offering flips one of the main key constraints of 506B. So it explicitly allows general solicitation and public advertising of the investment offering. Under 506C, sponsors can market their deals publicly. So you might have seen our posts on LinkedIn, through paid ads, at conferences, podcast episodes, email campaigns to broader audiences. The list goes on. The trade-off is that participation is restricted exclusively to verified, accredited investors, and the verification standard is meaningfully stricter. Under 506B, sponsors can rely on investor self-certification. The investor signs a document representing that they meet the accredited investor definition, and the sponsor is generally entitled to take that representation at face value, provided there are no obvious red flags suggesting otherwise. Under 506C, the self-certification isn't enough. The sponsor must take reasonable steps, so we must take reasonable steps to independently verify accredited investor status. This typically means reviewing the documentation of 2 years of tax returns, recent bank or brokerage statements showing sufficient net worth, or the most simplistic process, which we follow here, is getting a written verification letter by a licensed CPA, an attorney, a registered investment advisor, or also known as an RIA, or a broker-dealer that confirms the investor qualifies. This can create more friction in the onboarding process for investors and more compliance work for sponsors, but it also unlocks the ability to reach a dramatically wider audience at the top of funnel. For sponsors building a large-scale capital raising operation, that trade-off can be worth it. The takeaway from this side of things is if you've ever seen a real estate investment opportunity promoted openly on social media, a YouTube advert, or a broadly distributed email to people who you've never interacted with, or sponsors that you might not be super familiar with, that offering is almost certainly structured as a 506C. The sponsor can market broadly, but every investor who actually writes a check and deploys capital towards that asset must be verified as accredited. We discussed what a accredited investor means a few episodes ago, but I felt like this would be an appropriate podcast episode to review those definitions. Disclaimer, obviously, I am not a tax or wealth advisor. I'm not a fiduciary, and I'm not your financial advisor. But these are all things that you can verify online for yourself. So since both exemptions involve the concept of accredited investors, let's talk about those specifics under the SEC definition. Under the SEC definition, an individual qualifies as an accredited investor if they meet any of the following criteria. So, a individual with a net worth exceeding $1 million, excluding the value of their primary residence. That means liquid assets, investment accounts, secondary real estate, business interests, other assets minus liabilities that total over $1 million, not counting the home that you live in, so your primary residence. Or an individual that has an annual income exceeding $200,000 annually, or $300,000 jointly if with a spouse or a spousal equivalent in each of the 2 most recent calendar years, with a reasonable expectation of reaching that same threshold in the 3rd year. So if you have on your W-2 received $200K or more as your individual compensation, or $300K or more with your partner, and nothing has changed, your job hasn't changed, or at least you have an offer somewhere else that shows a reasonable compensation package that is showing that, then that would verify your accreditation status. There are also knowledge pathways. Holders of Series 7, Series 65, or Series 82 licenses qualify regardless of their income or net worth. And certain knowledgeable employees of private funds can also qualify in that specific context. So entities can be accredited investors, partnerships, corporations, family offices, and certain trusts also meeting specific criteria. And those are just a kind of a handful of things. There's a couple of other ways that you can prove accreditation status, but those are the most general highlighted points. So why does this matter? Because the accredited investor standard is a regulatory proxy for sophistication, the SEC's view is that accredited investors, by virtue of their financial position or professional knowledge, can better absorb the risk of illiquid, complex private investments and therefore need less regulatory protection. So, whether you agree with that framework or not, understanding where you stand relative to that definition determines which deals you can access and under what structure. There are some practical implications for investors when they're evaluating deals. So, you're looking into a real estate investment opportunity. There's a Regulation D filing number somewhere in the documents. What should you do with that information? First, identify which exemption is being used. The offering documents, typically the PPM or the private placement memorandum or the subscription agreement, will specify whether the offering is made pursuant to Rule 506B or Rule 506C. If that's not clearly stated, ask. Second, your obligations as an investor under each structure. Under 506B, you'll typically be asked to self-certify your accreditation status by signing a questionnaire. You're representing to the sponsor that you meet the definition, so take that representation seriously. It's a legal statement. Under 506C, expect to provide documentation. The sponsor is legally required to verify your status, not just take your word for it. Have your tax returns, brokerage statements, or a letter from your CPA ready in advance to make the process smoother for everyone. Third, use the structure as a signal, not a verdict, about the operator's approach. Sponsors who operate primarily through 506B are typically mostly relationship driven because they have to be on the top end of the funnel. Their investor base is built through genuine connection over time, which correlates with more curated, trust-based approach capital formation. Sponsors using 506C may be scaling more quickly and reaching out to investors they don't have relationships with yet. This is not inherently problematic. We here also use 506C raises, but it does mean that the due diligence burden falls more heavily on the investor to evaluate the operator independently. Given that some of the newer investors from the top of funnel in a 506C raise may not have a pre-existing relationship with that investor. So my RR hat, I would encourage all investors to evaluate your operator independently. Make sure that you're working with a good operator. This is a common thing across all of our podcast episodes. For anybody that already has a built relationship that is investing or a repeat investor with an operator, this evaluation can go relatively quickly or be unnecessary. One of the most frequent misunderstandings I encounter is that the idea that a 506C is somehow newer or better or more legitimate version of a 506B. So neither is superior to the other. They're tools that serve different purposes. A 506B offering from a deeply experienced operator with a long track record and well-cultivated investor community is not less rigorous than a 506C offering from a newer sponsor who happens to be good at social media marketing. The exemption tells you about the structure, not about the quality of the deal or the operator. Another misconception is that the prohibition of general solicitation under 506B means that these sponsors are flying under the radar or avoiding scrutiny. The opposite is often true. Operators who build genuine connections over time, who invest in education, transparency, real communication before even asking for capital, are often the ones who are focused on long-term investor outcomes. So the relationship requirement isn't a limitation for them. It's consistent with how they operate. And the last misconception that I would pull out is that if someone is raising for 506C, they don't have an established investor base. That is also not true. So we raise in 506B so that we can advertise and market our deals to a broader audience, but we always release them to our current investor network first. So we have an internal soft launch. Our last couple of deals have been oversubscribed, so we want to make sure that we reward loyalty for any of our current investors. And if that were to fill up before we were to go to market, we wouldn't market the deal. But we love investing in new MSAs. We want to be able to enable LPs and new investors to invest in their own backyard. So that is the main reason why we operate here at Focus Capital under the 506C rule, than the 506B rule. This doesn't mean that we are any less relationship driven. It just means that we would like to market to a much wider audience than just our current investor base. My last point has to do with what investors should watch for in offering documents. If you're reviewing a private real estate offering and you want to be a more informed participant, there are a few things that are worth looking for that are just beyond the 506B or 506C designation. The date of the Regulation D filing. Sponsors are required to file Form D with the SEC within 15 days of the first sale of securities. You can actually look these up on the SEC's EDGAR base or EDGAR base. This is a database that is publicly searchable. Reviewing a sponsor's filing history can tell you how many offerings they've conducted, when they filed, and in some cases, the size of the raise. The state blue sky filings, most states have their own securities laws, often called blue sky laws. And those require separate notice filings, even for federally exempt offerings. So sponsors operating in multiple states should already have this handled, but it's worth asking about, particularly in deals where investors are being solicited to across state lines. The legend language in the offering documents. Properly structured offering documents include specific legends and disclosures related to the Regulation D exemption, restrictions on resale, and investor qualification requirements. The presence of these disclosures and the specificity of them is a signal of the legal rigor. So all of these points just point to an operator that knows what they're doing, has the structured protections in place, and is operating above board according to the SEC. 506B and 506C are not just technical footnotes. They're a window into how an operator approaches capital formation. So whether they're building relationships over time, and or casting a wider net for a newer audience. They define the rules of engagement for both parties. So the next time that you encounter either designation in an offering, you'll know exactly what it means, what it requires of you as an investor, and what it signals about the operator's approach. That kind of informed participation makes you more confident and protected as an investor, regardless of which structure the deal uses. If you have any questions, as always, feel free to reach out to us at investors@focuscapital.com. See you in our next episode. Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. Take care, and we'll see you next week.